In the meantime, we are focusing on more market-moving developments, including oil moving to 4-year highs and, well, interest rates at better than 7-year highs. The two are lately tied to the hip here because they could reflect an improving economy. To oil analyst Stephen Schork on all of that. Stephen, are they connected? How do you see it?
Well, absolutely. I think that, Neil, this notion out there that was floated a couple of years ago when oil prices crashed, that somehow this was good for the economy, quote unquote, gave you a tax break. That's baloney. Commodity prices, industrial commodity prices, such as oil, such as steel, rebar, copper, so forth, crash when the economy is poor. We've had a nice rebound over the last 2 years in all industrial commodities, and this is a reflection of a stronger economy. Economies drive commodity prices, Neil. Commodity prices do not drive economies. Weak commodity prices equal weak economies. A rebound, strong oil prices, commodity prices are a reflection of a strong economy.
Is that a strong global economy, Stephen, or is it just unique to the United States? How do you describe it?
Well, the United States is in an absolutely unique position, given that the growth that we've seen in our oil infrastructure. In fact, the United States has the comparative advantage of access to some of the cheapest energy out there for our manufacturing sector, hence why the lack of growth in that sector during the previous administration is a real head-scratcher, given that we had such an outstanding advantage given that. So now what we're looking at here, Neil, is that over this past summer, demand for crude oil here in the United States has never been stronger. At the beginning of the summer, on top of that, we lost access to a significant amount of Canadian crude oil because of an outage at a processing plant up in Calgary. In April, the state of Texas was exporting more crude oil than we were importing. And yet, by August, global crude oil supplies, Neil, were never greater. OPEC supplies of crude oil were at a 9-month high thanks to strong output from Saudi Arabia, Nigeria, and so forth, which overcame significant loss of Iranian, Venezuelan crude oil. So the market is indeed in balance. So there is a bifurcation there where the U.S. is pretty much your leader in economic growth, and yet the world is still in balance. Hence why OPEC is turning a deaf ear to Trump's demands that they do somehow lower oil prices going into the midterms.
What did you make of that? Very unusual, especially that setting, to go after these OPEC nations. Some of them, Saudi Arabia, for example, comes to mind, saying, you know, we've been trying to work to help you out, and this is the thanks we get. What did you think?
Well, absolutely. The Saudis are doing, they see the market in balance because it is in balance. As we go into the fall,
by the way, it's in their interest to make sure oil is stabilized because they don't really profit off it.
Absolutely.
Yeah.
No, and they lose long-term market share. Every dollar higher tick in oil prices is a dollar or therefore lower in an alternative fuel substitute into the market.
So why does the president do it, Steve? What do you think? There might be a strategy to this just to compel these countries, even Russia, not an OPEC member, to just cool it?
Right. Well, he's taking 18 Septembers ago, President Clinton released 30 million barrels of oil, or announced a 30 million barrel oil release because jet fuel prices and diesel fuel prices were up to 95 cents a gallon. This is in 2000. And he did that on the presumption of trying to help Gore in the election in November. So remove that 18 Septembers now. Trump is taking that playbook too. We already have an 11 million barrel release that is due, that comes out in October. Therefore, Trump, in my book, has another 19 million barrels to play with. So even though I do think OPEC, Saudi Arabia, is making the correct decision, taking a wait and see, especially when we don't even know what the fallout for the global economy is from this trade war, which started by Trump. So they're taking the appropriate action of sitting on the sidelines. But Trump does have 19 million barrels to play with between now and that first Tuesday in November.
The biggest thing he has going for him isn't that. It's the economy, right?
Well, and that's just it. So we're at a point now where we've had rising energy prices, but to my point earlier, rising prices are a reflection of a stronger economy. And hence, we haven't seen an impact on the economy because of these oil prices. Oil prices are not expensive. They're back to where they belong. What we've gotten used to over the previous 2 years are oil prices were so artificially low, we think that's the normal. No, that was abnormal. Oil prices are normal right now.
That's interesting. So, Stephen, you always are interesting. Stephen Schork, the Schork Report, the founder and editor, knows these markets inside and out.